Liz Ann, welcome back to the show and Happy New Year. Right now, Ben and I were just talking about this setup over the last couple days. It's been only a few sessions, but we've got the dollar firming up a little bit. The NASDAQ has kind of lost some of its momentum. What are you looking for to see if any of this develops into any weakness?
Well, I think yields are important, and the backup in yields, I think, reflects a number of factors. Some of it may just have to do with positioning, but I also think there have been some comments, kind of background comments, been some Fed officials suggesting earlier than expected tapering, even earlier than expected rate hikes, which, at least in the case of the latter, is not something that we expect. But to the extent the bond vigilantes come back and you think about the speculative fervor that has been witnessed in the market, that being a risk in and of itself, maybe one of the catalysts could be a move higher in yields than what is built into expectations, leaving aside the other potential catalysts, the obvious ones around political uncertainty and the virus resurgence.
Liz Ann, so as you hint that there were the bond vigilantes, I was kind of hinting at that at the top of the show too, or maybe we don't need any grand statements by the Fed. I mean, it seems like we've got yields kind of moving in this direction to begin with, but how do we do like the math? Is there any way to know when a stock investor might say, you know what, this makes me think twice about what I'm paying up for some growth company right now?
Well, that begs the question of whether a lot of the most aggressive players on the long side in the market are actually paying attention to math and traditional fundamentals, whether it's the discount rate valuations. And I would suggest, I think there's players in the market that aren't paying any attention to those fundamentals. You could argue that given that inflation expectations have moved up along with yields, keeping the real yield still in negative territory, that being the discount rate used to discount future earnings, that we're not in trouble yet. But again, I don't know that there's some threshold that investors are waiting to see, because that's what they've been trading off of. And if that breaches that threshold, then all bets are off. I think this has been a momentum-driven market that has proven, certainly in the case of the events of last week, to be able to look through really shocking macro events. That's probably not going to last forever, but what that catalyst is, I'm not even sure it necessarily is a function of some fundamental interest rate, other valuation threshold being hit.
Liz Ann, the sentiment situation, what's the update here from the last time we spoke? I'm looking at some of the charts. Some of these we've talked about before, the AAII, Bull Bear. I know you look at the Ned Davis one. ETF flows too looks like an addition here. I mean, what's the status? Do we just keep getting frothier?
Yeah, so the status is interesting. If you go back to last summer into early fall, you saw that speculative fervor a bit more concentrated. You certainly saw it in the options market, single stock options, naked call buying, but you weren't seeing it in many of the attitudinal measures, but you also weren't seeing it in some of the traditional measures like fund flows. Fast forward to the early part of November when we got the Pfizer vaccine news, and you sort of kicked the rally into higher gear, a more cyclical gear, a broader gear. That really brought along with it some of those, not just traditional behavioral measures like fund flows. You saw a couple of months there in the latter part of the year that were record-breaking.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more.
Comfortable forces with which we're dealing with as human beings. When a survey comes and asks investors, are you bullish or you're bearish, they might be inclined to say, yeah, I'm feeling a little uncomfortable, but it's not being reflected in what is actually being done in portfolios. So I continue to think this is a really important time to distinguish between what's going on the behavioral side of sentiment measures and what's going on the attitudinal side.
Liz Ann, how will we track when some of these kind of isolated sector-specific or thematic-specific bubbles, just to kind of use that word generally? I mean, I think it's hard to deny some of this is happening in some of these categories, whether it's EVs, 3D printing. It's like every other day there's a new sector that rallies like 40, 50%. I mean, it's just been nuts. How do we know if that finds its way into the broader market? How do we track to see if that has real kind of implications from a flows perspective? If it's a retail-driven rally and all of a sudden these things start dropping, should we assume that people go, you know what, I got to take some profits out of my Apple that I've been sitting in for years, or whatever that connection might be? How does that connect to the rest of the market?
I think it's a great question. I don't know that I have a precise answer to it. I think anytime you get into a speculative sentiment environment, in and of itself, it doesn't suggest immediate move in the opposite direction for markets. And it doesn't always necessarily require a catalyst. We saw back in March of 2000, the market just sort of finally started to fall under the weight of all of these excesses that we know with the benefit of hindsight were there. But it took quite a few years before they kicked in. I would watch what we've been calling the newly minted day traders and watch in areas where you do get significant reversals, whether it's in the cryptos, whether it's in small pockets of the market, to see if it starts to filter into selling by those same cohorts within the options market, within the single stock market, in those more traditional parts of the market, or whether for whatever reason you see sentiment not get dented at all, where, oh yeah, that's going through a corrective phase right now, but we're in a new paradigm, we're in a new era where some of these negatives that are not just macro negatives, but start to be seen in certain pockets of the market, if they're universally dismissed and sentiment stays incredibly frothy as you're starting to chip away at where some of this sentiment excess was most egregious, then I think you're setting the stage for a bigger problem in the market. But if you can have some of these corrective phases happen in pockets, much like you saw in September, early September was the peak in the outperformance of the big five relative to the rest of the market. We had the 3-week pullback in September. The big five were actually down in the teens, almost bear market territory, yet the rest of the market hung in there a bit more. We saw the same thing happen in October. So you could correct some of these excess via a process of rotation where money leaves those speculative areas and goes into other parts of the market. That would be the healthy way to unwind some of that excess without it bringing the overall market down with it.
Lizanne, I think that's a really interesting point, and the call back to September so important still as we look at a lot of these big caps over just this week that still ran into some trouble last week too. I mean, we see that this has been playing a major role in the market. In terms of where some of that froth stems from, if we look at the personal incomes and the way that stimulus has been able to offset the weakness in the economy, just from an anecdotal perspective, I think it's been hard to miss the way a lot of investors and individual traders are talking about what they're doing with some of this, the stimmy check talk. I mean, it's pretty nuts the way we see this connection. Should we assume that personal incomes remaining high, or at least any influx from the government further, will find its way into the market? Or this year, might it change? Might those stimulus checks go into, Expedia or, booking events or concerts? I mean, are we there yet, or is there still such limited options that this money is going to find its way into the market?
Well, first of all, it's virtually impossible to try to look at the weight of stimulus checks and trying to make a judgment of how much of that has gone immediately after receiving it into the stock market and what components of the stock market. You've seen savings rates up, so we know some of it has been saved. You've seen boosts to consumption, to retail sales, certainly last summer when the stimulus checks were larger. So I think depending on who the recipient of that money is, it's going to go in different places. It's going to fund non-discretionary consumption or discretionary consumption or save for a rainy day. I think the longer the problems associated with the virus go and the further out it is before effectively we're all vaccinated, I wouldn't be surprised to see if more of that money was geared toward rainy day funds, to put it in air quotes, and less into the market. I think more of sort of this market surge has been less about stimulus checks, but more just about demographics of people working from home, younger folks. Certainly we know all the stories about not having sports betting, but having time in their hands, much more comfort and constant use of all things digital. I think it's been a cacophony of things that have led to this increased participation by certain individuals, and I'm not sure stimulus checks is the biggest part of that story.
Okay, so maybe just a part of it in terms of the overall backdrop here for how comfortable people feel taking risk and the connection between the market and the economy. Obviously, this was a tricky one over the past year, given that we had such a major breakdown in the economy. One of the things that you've been watching very closely is the permanent job losses. When we look at this, it seems like maybe we have seen possibly the worst of that, Lizanne. What do you see when you look at this chart of temporary versus permanent layoffs?
Well, I certainly hope that the hook back down in permanent job losses is the beginning of a trend in the right direction. On the other hand, we saw an uptick in temporary job losses, as you can see in the blue line in the chart that's showing. And I think that's a function of the fact that 140,000 payroll jobs lost last month, 500,000 jobs lost in leisure and hospitality. Fortunately, some of those job losses were temporary, hence I think the pickup in temporary. Permanent starting to roll over and move back in the right direction. We don't yet know whether it's a 1-month blip, but the relationship between these two, I think, on an ongoing basis is extremely important. It's great news that a lot of payroll gains until last month were people who were unemployed temporarily getting their jobs back, but permanent job losses and long-term unemployment, more than 27 weeks. I think those are the two key metrics within the labor market right now to keep a close eye on, to get a sense of what the scarring is on the economy of the effects of the combination of the crisis that was the virus and then the crisis that became the recession associated with that. So I think these are really important metrics, more so than the typical headline numbers that we focus on with regard to labor market indicators over the next several months.
Lizanne, one more before the bell here. Let's say we do see that rate continue to go down in terms of the permanent job losses, the connection to the market then at this point, what is the implication of that? Is that a broad, strong relief rally as the economy gets back in line, or is this more of the bifurcated style of market dynamics that we saw from September to October and now the past week again, where we're just split in half, growth versus value, cyclical versus tech?
Well, I think what's going to be interesting as we start to see a pickup in traction in the economy, and whether it's data around things like long-term unemployment or permanent job losses, I am actually concerned that if we get a real healthy surge in the economy, that will bring with it maybe a move up in yields beyond whatever the comfort zone is, and concerns that the Fed will have to step in. So I want to see great economic news. It's just a question of what is sort of the comfort zone for the market where the data is perceived to be Goldilocks in nature and not so strong that it sort of further brings out the bond vigilantes, causes a move up in yields that goes beyond, again, the comfort zone. Maybe that's an environment that is still beneficial for the equity market, but we're in a strong equity market environment right now, and I'm never a contrarian just to be a contrarian, but it's my job to think about, okay, what are the risks here? What could possibly be the story that comes out that causes the market to move in an opposite direction? And I'm not sure the only stories that would cause that would be all negative in nature, either virus related or economy related. I think there's kind of a bit of a binary risk with regard to, could there be an environment where the pickup in growth is too strong and it incites price shocks that might be perceived to be inflation, et cetera. So another thing to be mindful of, even if we're rightly so cheering better economic data.